Good afternoon. Hi, and welcome to Next Generation Equity, a discussion of Vanguard's move to use new CRSP or CRSP indexes in its domestic equity ETFs. And this is the latest installment in the ongoing IndexUniverse webinar series. My name is Dave Nottig. Myself and Matt Hogan will be the hosts for today's webinar. I'm the Director of Research here at IndexUniverse, Matt Hogan of ETF Analytics. I'm pleased to be joined today by a slightly larger than usual panel of experts to talk about this shift in Vanguard's strategy and why they chose the CRSP or CRSP. We're going to end up calling it CRSP probably for most of this webinar, the CRSP series. From Vanguard, we have Joel Dickson. He's a principal at Vanguard who's been intimately involved in the move to these new indexes. He'll be joined by David Barkley, COO of CRSP, and John Heaton and Lubos Pastor, two of the academics from the University of Chicago Booth School of Business who've been instrumental in developing these new indexes. The format for today's webinar is simple. For the first 25 minutes or so, we've asked the folks at CRSP and Booth to talk about their approach to indexing as new indexes have come about, with a little bit of history on where CRSP comes from. Then Joel's going to walk us through Vanguard's decision-making process here and more critically, what these new indexes really mean for Vanguard ETF investors in the coming year, both in terms of the transition to these new indexes from the existing indexes and what investors should be expecting of these new portfolios. Following the presentation, we'll have about 20 minutes of audience Q&A where you can ask questions of us. And we anticipate, as always, a lively Q&A discussion. As a participant in this webinar, you're invited to ask questions at any time. There's a Q&A panel in the lower right-hand side of your screen. Don't feel the need to wait to the end. If there's a question you have about a particular slide, a particular point that's being made, go ahead and get those questions in early. We'll collate them all towards the end of the webinar and answer them as many as we can before we wrap up. We always get asked from participants whether or not slides will be available or whether a replay will be available. So I'm going to go ahead and answer those two questions right now. A recorded version of this and all of our webinars is always available on our website within a day or two of the conclusion of this webinar, along with the slides. They'll be made available at IndexUniverse.com. And as a participant in this webinar, you'll be emailed when those things are posted. And so with that, I'd like to hand this over to the folks at CRSP. And I think I'm handing it off to David.
Yeah, and John at IndexUniverse, is there any way to get the slides in landscape mode? And
yeah, one sec. We'll see what we can do there.
And should be back at the beginning.
One second, folks. We'll get this settled down. Maybe while we're waiting, I think it might be useful, Joel, if you could tell us a little bit about the relationship between Vanguard and CRSP and really how this partnership started, and we'll let our tech guys work on this in the background.
Sure. So, Vanguard and CRSP have actually been working together for several years at this point in terms of just sort of discussing and consulting, if you will, on a series of what has resulted in CRSP's investable indexes. And as you're going to hear from David Barkley and the others here at CRSP shortly, CRSP has a long, long history in terms of indexes from a research standpoint, and is one of the preeminent data sources and providers for both academic and money management firms in terms of stock level data that get into indexes and also as a research database for many investment firms. So it's in our view a natural extension to have sort of real-time investable indexes produced by CRSP, and we started talking several years ago with them about how that might occur, and taking into account the landscape that's out there today in the index development area and in the index construction methodologies, and really building on some of the work that Gus Sauter at Vanguard had commented on and discussed now over 10 years ago in terms of best practices in index construction methodology, and how the industry really has converged in a series of best practice measures over the course of the last decade, especially on the U.S. equity side. Things like free float and having bands to minimize or at least reduce turnover and transaction costs in the normal course of index management. And CRSP really has been a great partner in terms of thinking about developing and really providing a framework to continue to build on index construction and evolution in this industry. And so we've been excited when we saw what indexes they constructed and how they were going about doing it. We were very very happy, and that was the main reason why we saw that as an opportunity to use these new indexes in our domestic equity funds.
Super, that's helpful. I think we have the slides fixed here, at least they're fixed on my screen. If you guys wanted to advance forward into the presentation, I think we can get going.
Okay, thank you. This is Dave Barclay cutting in. With that introduction, thank you, Joel. We want to talk a little bit about CRSP, because people are asking who is CRSP in this space, and talk about some of the highlights of our indexes. As Joel mentioned, in developing our indexes, we were guided both by industry best practices and also our academic research and a review of current research in this space. Our faculty advisors, Chicago Booth professors John Heaton and Lubosh Pastor, have certainly been very, very central to the development of our unique methodology. John and Lubosh will cover the highlights of this methodology in their portion of the presentation. First of all, I would be remiss if I didn't say something about Chicago Booth. I hope you are at least, and Joel is reminding me I have to advance slides here. We hope you are at least somewhat familiar with us, particularly since our renaming back in 2008, thanks to the generosity of one of our alumni. Founded in 1898, we pride ourselves on being the second oldest business school in the country. Unfortunately, our friends at Wharton beat us to that distinction. We've had 6 Nobel Prize laureates on our faculty. We are consistently ranked in the top 5. We have programs on 3 continents. We have a global body of nearly 47,000 alumni. Who is CRSP is the next question. CRSP licenses data products to academic institutions, investment bankers, brokerage firms, corporations, banks, and government agencies. This is a research center. It is part of the University of Chicago Booth School of Business and one of its 11 research centers. Part of our mission is to further the collaboration between the academic, commercial, and governmental sectors, and in pushing back the frontiers of knowledge to positively impact business practice. Certainly these indexes qualify in that consideration. We are a premier provider of historical data, ranging from common stocks to REITs to indexes. We have been producing indexes since the mid-1960s along with our historic data. Our data spans 87 years. We have 500 clients in 32 countries. We delivered total returns to the NASDAQ exchange from 2003 to 2009. And we have 34 people dedicated to the indexing side of the business, which puts us at the rather small end of the spectrum. I would last like to point out that CRSP is advised by a distinguished board of directors, Gene Fama being perhaps the best known and referred to by many as the father of modern finance. I also specifically want to call out John Heaton. John is one of our two faculty advisors on this index project and is also Deputy Dean for Faculty here at Chicago Booth. I now need to turn the podium over to John and Lou Bosch because they're the ones you guys want to hear from this afternoon.
All right, thanks, David. This is John Heaton. My job here today is I'll talk through just the basics of our philosophy and how we constructed some of our indexes. In the context I used to begin with, I'll talk through our cap-based indexes and how we deal with things like migration and how we made the various choices that we made. And then Lou Bosch will carry on and talk a bit more about the style-based indexes, how we define style and construct those indexes. So let me repeat something that David said. In terms of the way we're thinking about these indexes, we have two objectives really in mind. First, there's a wealth of academic work looking at the impact of style or market cap on performance or risk in portfolios. So we certainly know a lot about that work. But then there's actually practice out there that sometimes doesn't match exactly the academic perspective. So the objective really was to balance these two different perspectives. And of course, we got very good input from Vanguard in thinking about the practitioner component of that as well. So that was our basic objective. So let me illustrate that and let's talk about the cap-based indexes, and we're on the slide that asks how CRSP defines size. A common practice, of course, in the industry is to define size based on numerical values, like 2,000 stocks, say, in an index. When we went back, we thought it makes a little more sense in a sort of a world that's evolving to think about relative market cap, proportions of market cap. So in particular, what we ended up with, and I'll talk a little bit more why these choices, but we ended up with cap-based indexes that are delineated by percentage of market cap. So the way to think about it, of course, is you order stocks, say, from the largest to the smallest, and then look at chops where you have a accumulated percentage of market cap. So for example, our mega cap index has the top 70% of market cap by the largest firms, largest stocks, excuse me, and then the mid cap would go from 70 percentile to 85 percentile, and so on. So we take our standard universe. The universe is, I noticed there were some questions about how we define universe. Pretty standard notion universe. We have some liquidity cutoffs and so on. They're pretty standard. But then we take that universe and delineate it into various levels of market cap based on accumulated market cap. So notice there's no limits on the number of stocks that are in each of these bins. I'll show you some numbers later. The numbers will look, pretty reasonable, I think. But from the beginning, we thought it didn't make sense conceptually to limit ourselves to just limited numbers in a particular universe or market cap index. So let me go to the next slide just to illustrate one issue, and there are other issues here. If you think about an index, say, with a fixed number, say Russell 2000, and I'm not meaning to pick on them in particular, but just as an example, it's a small cap index, and you think about in a world where the number of stocks is changing, and that's the world we live in. For example, in this slide, we go from 1999 down to 2012. We see the number of stocks has declined quite dramatically, and that's an interesting thing that academics are thinking about, where that trend comes from. But in a world where you have a fixed number of stocks in an index, the characteristics of the stocks you're going to pick up are going to change over time. And what we wanted is for our indexes to have much more stable characteristics, both in return characteristics and risk that an investor would face in investing in it. Now, of course, this creates a potential problem because we're going to introduce some trading effects. But at a conceptual trading cost, but at a conceptual level, we thought it makes more sense to define things by cumulative market cap as opposed to a fixed number. Now, the trading costs we'll come back to later. As you know, if you flip through and looked at our methodology, we're going to introduce banding and packeting to control some of the effect of those costs. All right. All right, so if you look at where we stand right now, well, this is September 7th. The cap-based index has been running for a few years now. So this is at the ranking or reconstitution in September 7th. You can see the number of securities and the market cap in the various cap-based indexes. The numbers, in terms of when we were thinking about where reasonable breakpoints should be, one of the things we, of course, looked at was industry practice. We wanted to be reasonably on track with the characteristics of other indexes and other ways that that managers actually manage money in this space. So we ended up with buckets of stocks that I think if you think about the range of numbers here, they'll seem familiar to you, at least relative to other index providers. And again, one of the objectives is to have characteristics of the resulting portfolios that look reasonable and familiar over time. Now, one thing you might notice if you look at this is that there's the total number of stocks in the total market index is 3,800. And if you add across our cap-based indexes, you've got to be a little careful there because there's double counting between the mega and mid adds up to large. But if you added the bottom three indexes there, you'd end up with a number that's not 3,800. And the reason that's happening is that as I'm going to describe later, there's partial weighting. Stocks can be in multiple portfolios. And that'll be an issue I'll come back to later. I know there was a question that was asked about how persistent this effect is and how big an effect it is. But let me come back to that. But there's not a typo on the slide. All I want to raise is not a typo here, and we can clearly add. It's just that there is a bit of a double counting because some of the stocks are in multiple indexes. So why don't I move forward and we can talk some more about how this works. Okay. So how do we maintain our indexes? So we have quarterly rebalancing, and I think I don't know if anyone has alluded to this. We have a ranking date and a reconstitution date, and we have some interesting ways in which we use the history around the ranking dates to come up with the ranking. But anyways, we rebalance quarterly. And then the idea when we're thinking about the index, we want to move from sort of this theoretical idea of these cap-based indexes based on cumulative market cap to a practical one, which is now going to involve trading as stocks move from one market cap to another. So we want to control that cost because that cost is the first order thing that investors face if they're trading or say a portfolio manager faces as they trade across market caps. We want to control that and minimize it for investors while maintaining the purity of our index. What do we mean by purity? Does it track the characteristics of the broad class in a world where you don't face costs? Right? So we have two components then what we consider. One is thresholding, where we have a security must exceed a band around the breakpoints, and this type of banding is common in the industry. But the other thing that we use is say, well, there's no reason to move the security all at once. Why don't we slowly move it, have slow migration? And the way we did that is to think about what we're calling packeting, but it's really just slow movement as the stocks go across bands. Now, what we ended up with, I'll describe the bands in the next slide, but what we ended up with is a migration where we move 50% of a security. And you might ask why 50%, and it's reasonable to ask why the size of the bands are what we chose. The way we thought about that is we thought about the trade-off that investors face between purity versus transaction costs. One way to have no transaction costs would be buy and hold, say a small cap portfolio, but eventually it will become a big cap portfolio, at least you hope. And that will then be impure over time. So there's a trade-off investors face, or you would face in practice. So what we looked at is various measures of impurity and various measures of turnover, including turnover by say, the median size fund managing in the space. If they had to trade, would they trade through? We looked at a threshold of, say, 10% of average volumes or not. And if they had to trade through more than 10% of average volume, we called that bad turnover. So we looked at how much bad turnover you might face, how much total turnover you face, and looked at a trade-off between that and impurity. And then we tried to come up with a reasonable balance of this impurity versus the turnover, and we came up with this, what looked reasonable to us, migration where we moved only half of the security at a time, and some bands. So let me show you what the bands look like. So let me describe the banding with an example. So if we go here on this migration example, so in this example, the company starts off at an initial point A down on the bottom in the purple there, where it's 100% mid-cap. All right? And so the break point between mega and mid, as we discussed before, is the 70th percentile. Okay? So the top 70% of market cap is mega cap. And then below that and beyond, we have mid cap and then small cap. But in this case, we have a stock that starts off initially at point A. Okay, and then a quarter later, the stock is increasing in value, and it moves through and now becomes the 69th percentile point. So it's above the break point. Now, what we come up with, though, is a band around this break point, and in this case, the band is 64% to 76% around our break point of 70%. So in this point, we say, look, and we know it's moved up. It's now technically mega, but it hasn't moved enough. Is it really going to stay there? So at this point, it's going to stay in mid-cap because that's where it started. All right? So then we watch the stock again at the next rebalancing a quarter later, and at this point, our little example, the stock is now moved above the band, the 64th percentile, to point C. It's now at 63%. So at that point, we say, okay, now it really is a mega stock. It should be in that index. But if you move it all at once, you're going to face transaction costs. So let's move part of it. And again, we looked at trade-offs to decide how quickly to move. We move now 50%. And if it stays there the next quarter later, in this example, Q4, the quarter 4 state, a year later after initial starting point of point A, it's still at point C, just in our thought experiment. At that point, it really is a mega stock. It stayed there. We moved the rest. So now it's fully in the mega index, and we've minimized transaction costs by slowly moving this over time. Now, again, there was this question, I think, about how persistent is this, this in-between zone, this 50-50 zone. If you look at where we were, what was this, about a month ago, we had 4 stocks that were in the split between mega and mid, 21 stocks between mid and small. In terms of percent of total market cap, it's 0.74% of total market cap. So it's not, you don't think about this in-between zone as a very large effect. There's going to be stocks there. They don't stay there because of these numbers. They're not persistently there. But the idea is to have slow migration and reduce costs for investors and managers. Okay, with that, let me move it over to Lubos to talk about the style-based index.
All right, thank you, John. So it's my job to tell you about how CRSP constructed its value and growth indexes. Broadly speaking, we take a multidimensional perspective to value and growth. We take into account how cheap or expensive a given stock is relative to its fundamentals, and we also look at the extent to which the fundamentals have been growing and are likely to grow in the future. Essentially what we do is that to construct, say, a large growth index, we start with a large cap universe, and then within the large cap universe, we sort stocks based on their value and growth characteristics. CRSP has done a fair amount of research in terms of selecting its factors, as well as, and in particular, weighting the factors, weighting their relative importance in coming up with the overall value and growth scores for a given firm. So here's the list of factors that CRSP uses to define value and growth. You'll see that on the value side we have 5 value factors, all of which are ratios. These are price multiples that, again, reflect the extent to which the stock appears expensive or cheap. You'll recognize all these multiples. They've been commonly used in practice. For example, the Russell Index, Russell Value and Growth Indices rely on book to price. MSCI that Vanguard has been using historically uses 3 of these value indexes. They don't really use the sales to price ratio or the historical earnings to price ratio. We find all 5 of these value ratios useful in defining value. On the growth side, we have 6 different factors that are informative about the future growth of the company. You see two types of analyst forecasts. You see 2 types of historical growth measures. And you also see 2 new growth measures, one of which captures the degree to which a company invests. The idea is the more a company invests, the more likely it is to grow in the future, and we have indeed found such a relationship in the data. And then finally, we have a measure of profitability or return on assets, which is essentially a measure of internal growth of a company. We have come up with weightings on these 11 factors in defining value and growth. And I don't necessarily want to go into the details of this math. All of this is available in the CRSP methodology guide. But I just want to give you a broad idea of what we're doing here. We are weighting the various growth factors with the understanding that it's the future growth of the firm that we care about. So we put a larger weight on future growth indicators compared to the historical growth indicators. We do care about historical growth to the extent that it helps us forecast future growth. And indeed, all of these growth factors help us forecast future growth. On the value side, we weight these factors somewhat differently from, say, MSCI. MSCI essentially uses an equal weighted average of 3 value indicators. We put more weight on the earnings price ratio. We find that to be an essential measure of value, and a somewhat smaller weight on the dividend yield. And then as a final step, we combine our value and growth scores into an overall score that we call the average rank. And I don't want to give you any math here. The whole idea is to see that there are 2 dimensions. There's a value dimension along the horizontal axis, and there's a growth dimension along the vertical axis. And then for each stock, we put it somewhere inside this square. If the stock is sufficiently kind of northeast of the main diagonal, it's going to be a value stock. If it's sufficiently southwest, it's going to be a growth stock. And you see there are these wide bands separating value and growth. These bands serve exactly the same purpose as what John has been explaining regarding migration. So we apply the same threshold packeting type approach, slow migration approach to our value and growth indices. A stock has to cross sufficiently deep into the growth territory in order to become a growth stock, and vice versa. The objective is to keep transaction costs low. So in the long run, the idea is to save money for Vanguard shareholders. Here are some properties of the resulting CRSP indexes. On this chart, you're looking at 5 value factors. These are the 5 value factors that CRSP uses. And you're looking at the values of those 5 factors for small value and small growth indexes. So each red bar shows you the corresponding value for small growth. Each blue bar is the value for is the quantity for the small value index. And all the values here are intuitive. For example, take the forward price earnings ratio, which is an important quantity in our indexes. Our small growth portfolio has a P ratio of 23. Our small value has a P ratio of 13. On the historical basis, the difference is even larger. You can look at the price to book ratio, the price to sales ratio, the dividend yield. You see that our value stocks have 3 times the dividend yield of our growth stocks. All of these quantities seem reasonable. I have the same chart here for our growth metrics. You may recall we have 6 growth metrics overall. And again, the red bar indicates the value of the metric for a small growth portfolio. The blue bar is the corresponding value for small value. And in all of these cases, as you would expect, the firms that are actually growing faster or have been growing faster or are anticipated to grow faster have higher values of these metrics. So this is just, in some sense, a sanity check for our value and growth indices. And finally, in case you're interested in the sector composition of the value and growth indices, here's an example. You're looking at sector composition of our small value index on the left and the sector composition of our small growth index on the right. And these look very reasonable. Give you a couple of examples. If you look at the technology sector, it accounts for a little over 6% in our small value, but it accounts for much more, almost 17% in small growth. So not surprisingly, we classify technology as growth. Not surprisingly, we classify healthcare mostly as a growth industry as opposed to a value industry. And not surprisingly, we classify financials mostly as value as opposed to growth. You'll notice that financials, the weight on financials in our small value portfolio is almost twice as large as the weight of financials in our growth portfolio. So these are all things that you would see based on other indexes as well. Overall, the broad philosophy here behind these value and growth indexes, the multidimensional perspective, mixing with the different weights, all of this is fairly similar to the way that MSCI, the former index provider for Vanguard, has been doing it. So you're not looking at any major departure in philosophy, but we do have a couple of additional factors that make sense. We do have weightings on these factors that our research shows are helpful in classifying stocks as value and growth. So there are some departures, but we believe that they're all for better. So to summarize, I can do this.
Oh, very good.
I can do what the team over there takes 5 minutes to do. All right. Let's see. CRSP is very well known in academic circles. For more than 50 years, it's been the leading provider of data to academics, and not only academics, but to government institutions and businesses. And these new CRSP indexes are perfectly aligned with our mission of providing indexes. So there's a lot of expertise here. The main features of these indexes would be, the novel features would be, in terms of size, we have cumulative breakpoints, and we have this packaging approach. We have partial weighting of stocks in cap-based indices. And in terms of value and growth, we have a couple of additional factors, a different weighting, a multidimensional perspective on growth. The overarching objective here is to keep indexes pure with respect to style, and at the same time minimize turnover. Let me hand this to Joel.
Great. Well, thank you, Lubash and John, for going through some of the little details of the indexes and the construction. And as Lubash mentioned, it very much is an exercise of largely, yes, differences in methodology, but at the end of the day, most of the indexes that are high-quality indexes that established with best practices, and by the way, our current index provider for Vanguard's fund is a high-quality, best-in-class index provider, as is the CRSP indexes. So it's an approach that to us makes sense. Yes, there are some differences, but at the end, you're getting exposure to large cap, if it's a large cap index, to small cap growth if it's a small cap growth index. And we think you can do that in a couple of nice features of, one, the relationship that we have established with CRSP, but also from the standpoint of how we actually think the CRSP indexes will evolve, ultimately means that we think you can access these high quality benchmark appropriate indexes in a way that is lower cost over the long term for investors, both in terms of the licensing fees that you're paying to access the indexes, as well as the transaction cost in maintaining an existing index. And I think some of what's been, in some cases, clouded over or maybe even lost in some of the discussion about transitioning from an old index to a new index, with an index change, is that even existing indexes have a natural level of turnover and transaction costs in them each and every year. And in fact, just to demonstrate that, this slide shows for the Vanguard equity funds that are being affected on the domestic equity side, the Vanguard domestic equity funds that are being affected by the index change, shows what their portfolio turnover rates were in their last full fiscal years. And so you can see that, especially if you're in smaller cap or style-based portfolios, there is a natural run rate of turnover that is far from being zero. Things migrate all the time, whether it's value to growth or small cap to mid cap. And so where you tend to see low turnover in indexes is in broad market or large cap blend portfolios, and you tend to see much higher turnover in style and smaller cap equity portfolios. And the point of this is just to say there's a natural amount of turnover and expertise that is required to execute on an index portfolio on an annual basis. And, we think we have a lot of expertise at Vanguard, having done this for, more than 35 years now on the equity side. And, I'd even say, if you want to see how this can be managed, IndexUniverse with their ETF analytics tool shows a return series based on tracking difference. And the tracking difference in Vanguard's portfolios generally has been very, very close to the index return, even after incorporating all of these transaction costs from the maintenance of the indexes over time. The reason I point this out is that this move from the current index to the CRSP indexes in these portfolios is in many ways the same amount or similar amount of turnover as doing an annual rebalance of an index. And so it's something, again, that we do all the time and have done regularly. So, it's a balance. We're always looking at how do we, with the experience, minimize, you're trying to minimize at the same time the tracking error and the transaction costs. And that's really the balance that we're trying to achieve. So where do we see the cost savings going forward? I just would like to highlight that when we talked about the announcement and moving to CRSP indexes, we said, we believe there are long-term cost savings and better cost control over time in terms of index licensing fees. But again, I would just highlight that I think that the way that CRSP has developed its index methodology means that we also believe, based on what we have seen thus far, that there is also a lower run rate, especially on the style indexes, in terms of annual turnover, that we believe also will result in cost savings through the form of lower transaction costs to maintain the indexes. In terms of transition, and I'm going to highlight three funds here in just a moment just to show some differences. But in terms of transitions, it is going to be staged over the first half of 2013. We're not really going to pre-announce when transitions for particular funds will occur, and that is because from an investor standpoint, we don't want to give any information that we don't have to that could be used against investors in the funds through front-running of potential trades. Because, you can pretty much do the math yourselves. You can figure out what the current portfolio holdings are in the fund, Chris publishes the portfolio holdings of the indexes, and you can pretty much create a trade list on your own from that. And so we don't want to be then adding fuel to the fire, if you will, by saying exactly when we might be trading those. However, what we will be doing is immediately following the transition of any of the portfolios, we will announce that it is now tracking the new CRSP index when that does occur. And again, these are being staged over the course of the first half of 2013, and they are being staged in a way that makes sense from a transaction cost standpoint. So for example, there might be securities in which, say, mid-cap is selling a particular security and small-cap is buying a particular security, and where those can be managed so that they are just, you don't have to really sell them in full. Instead, you can transfer them between portfolios. We will do that to minimize, again, transaction costs and impact. Overall, before I get into these three funds, overall, if you look at a one-way turnover rate on the domestic equity funds, it comes out to about a 10 or 11% one-way turnover across all the funds, of which, if you just look at the strict buys and sells, more than half of that could be crossed, where there's a buy and a sell across multiple portfolios. Now, when we're actually executing on that, it might not be quite that full amount being crossed, just because it's going to depend on cash flows and timing and so forth. But it really is a fairly low number as a percent of assets in terms of the aggregate trade in the overall portfolios. Now, that doesn't mean that there aren't some differences at the individual fund level, and so let me sort of compare and contrast three different portfolios, and I'm going to start with one that actually has pretty low turnover and not much in the way of transition in terms of before and after portfolio in terms of what it looks like, and that would be total stock market index, or the ETF being VTI. You can see from a market cap standpoint, from a PE ratio standpoint, very, very similar looking portfolios. Slight increase in the number of names, though actually, because there's a little bit of sampling at the very bottom of the portfolio, you're probably not going to see that much difference in terms of the number of names. But again, it's all that number of names difference is almost exclusively in the 0.2% of market cap that is micro cap in terms of the definition under the indexes. So it's not a meaningful percentage of the portfolio. And you can see that too in the sector weights before and after in the fund, where they are pretty much right on top of each other, because a broad U.S. equity market portfolio looks pretty similar. The minor differences being a little bit in terms of the number of names at the bottom and a little tiny times difference in float adjustments that are done on individual securities and free float. But pretty much it's the same general portfolio before and the same general portfolio after. And in this case, the one-way turnover on this portfolio is probably going to be in, say, the 3% range. So very little in terms of overall transactions. Now, if we compare that to, let's say, mid-cap index, in this case, it looks like the one-way turnover is probably going to be on the order of about 20% in this portfolio. And a lot of it is due, as John was talking about earlier about the market cap breakdown, because of using the fixed percentage of market cap instead of the fixed number of names, there's actually a little bit of names that are currently in Vanguard's mega cap index that are going to be transitioning into the mid cap index. That's about 11% of market cap based on current estimates, give or take. Or think of it as more than half of this turnover that's going to be required to move to this index in mid cap is actually generated from the pretty large and liquid names that are formally in the mega cap segment. And again, that's just because of the number of names approach of the current index provider versus the percentage market cap breakpoint of the of CRSP. So a little bit higher weighted market cap, PE, somewhat similar, number of securities, somewhat fewer. But again, it is a mid-cap portfolio from the standpoint of its overall representation. And again, you'll see pretty small differences in terms of the sector allocations in the portfolio. A little bit on the consumer side, but again, that's that migration of names that have come down from mega cap that are just adjusting that just so slightly. The final one that I would just highlight is one of the ones that will have a little bit more turnover, at least at the individual fund level. And again, we're looking at this as we're trading it across funds as well as within funds. And that would be the small cap growth fund. And in this case, the one-way turnover is probably going to be on the order of about 35%. And again, though, most of it is coming from names that under the fixed number of name methodology are classified as mid-cap under the existing index provider and will be moving into the small cap index under CRSP's methodology. But I think the thing to highlight that really strikes us, and Luboš mentioned it earlier in terms of the characteristics of the value and growth indexes, is you can see that while there's a little bit higher median market cap, it also looks like a small cap growth portfolio. If you look at the trailing PE, for example, you're talking about 24 times earnings. So it does have the characteristics of a growth portfolio. And then just finally, the sector weights. And this is where you'll see a little bit of differences because, again, there are differences in value and growth definitions between different index providers, and that's true whether it's CRSP or MSCI or Russell or S&P. All have sort of different approaches, as, by the way, do many active managers have different definitions of what is a value stock and what is a growth stock. And as Luboš was mentioning, the bands that are being used in the packeting approach on the style really helps to reduce that measure of bad turnover that John was talking about in the context of the market cap profiles. But in the research that at least CRSP has done, without really hurting the style purity of it looking like a growth portfolio, looking like a value portfolio, these wide bands control turnover quite a bit. And so, our expectation, as I mentioned at the outset of my remarks, being that the run rate on the style portfolios from a turnover perspective is likely to be quite a bit less going forward, and that means obviously lower transaction costs in the maintenance of the index. The big change in the sector weighting standpoint is the financials. You can see that it's been noted, and it's not to say that the indexes view financials as growth companies. They don't. The majority of the market cap of the financials is still value. It's just a little bit less deep value than some of the other index providers have, and so it is showing up a little bit more in the growth sector in terms of some of the financials, and that's the reason that you're seeing a little bit more in financials in the small cap growth space once the transition will be complete. So that, I hope, just gives a sense of the transitions and how we're thinking about it, and I'm sure there will probably be additional questions on that in the Q&A. But at this point, Dave, I'll just turn it back over to you to talk, to deal with the Q&A.
Sure, thanks. First, I just want to say thanks for some really fascinating discussion. I think this has been great transparency in terms of just showing us the decision process here and what the real strategy here is for Vanguard picking these indexes. I'd encourage folks to keep asking questions. We've gotten a tremendous number of fantastic questions. We may not get through them all, but we'll keep collating them and try to pick the juiciest ones out between now and the next 15 or 20 minutes. I'll answer one question right up front. I've had a bunch of folks already ask me whether or not slides will be available. Yes, they'll be available on our website, and if you attended this webinar, you'll get an email letting you know when those are available. I wanted to ask some of the sort of nitty-gritty questions, right off the bat, while they're still fresh in our minds. I think, Joel, you just finished up talking about the sort of the difference here in sort of growth value methodologies, and we've had a couple questions where folks have sort of questioned this idea that you've got independent measurements of growth and value, and whether or not that creates sort of some unintended consequences or some sort of paradoxical situations situations where you end up with companies that are great value companies by your formulas and great growth companies, and whether that sort of dilutes any kind of style purity you're getting between the two of them. Joel, maybe you want to start with that one and hand it off to the folks at CRSP if you think you need to?
Well, actually, I'm gonna pretty much put this right over to Luboš because he loves talking about this exact topic, and I can almost bet that he's going to mention Southwest Airlines.
I mind. I mean, that is an example of a company that does not fit neatly into these value and growth boxes, in that it looks very growthy and at the same time very value. But it's very traditional in the industry to look at both the cheapness of the security as a measure of value and its growth rate as a measure of growth, and then putting the two together to create a combined measure of value and growth. So in this sense, we do not depart in any way from industry practice. Our measures of rank of value and rank of growth, which are sort of the ultimate measures of value and growth that are subsequently combined, those measures exhibit a correlation of about 50% across firms. So firms that look like value according to the cheapness indicators also tend to look like relatively low growth firms according to growth indicators, and vice versa. The correlation is something like 40 to 50%. It varies over time. So it's imperfect. It's what you would expect based on other indexes such as Russell or MSCI.
The other thing I would just mention, adding on to that, is as we have seen the evolution of indexing over a few decades now, it used to be common practice to have value and growth be defined the same way, and that is, have a single variable, say it's price to book, and if it wasn't value, then it was growth, and vice versa. And over the last decade, one of the best practices that we feel is important, that, again, Gus talked about in research, a decade or so ago, as well as what we have seen in industry practice over the course of the last decade, has actually been to define value and growth separately for some of the very reasons that Luboš just mentioned. And so that actually has become sort of the standard best practice in the industry today.
Yeah, we had a couple of other questions on the sort of growth value thing, which I think is the one that I think most people are going to have the hardest time wrestling with. I think you've done a great job explaining a lot of the packaging issues and sort of the migration issues across bands. Although I think a few people were a little confused about your market cap chart until they realized you were adding up the market cap of the whole market, not doing averages, until they saw the trillions on the bottom. But back on the growth thing, we got a couple of what I would call eyebrow raises in the questions for the inclusion of quote-unquote future growth metrics in the growth methodology. Can you talk a little bit about how you approach that idea of potential future growth and why you think that's got real statistical relevance here? Why you think those predictions are valuable?
Right. So we looked at a couple of criteria that we wanted our growth factors as well as their weights to satisfy. First of all, we were looking for factors that have predictive power for actual growth of fundamentals. So we looked at future sales growth, we looked at future earnings growth, we looked at what we call the measures of composite growth that put the two together, and we found that these forward-looking measures of analyst forecasts of earnings growth are both the long-term and the short-term one, are both very useful in forecasting future growth, not only the growth of earnings, but also the growth of fundamentals. These forward-looking measures actually did better than any of the historical measures of growth, and that's why they received the largest weights in our growth composite scores. In addition, we found that the historical sales growth is very useful, more useful than the other historical measures in forecasting future growth. And finally, in addition to forecasting future growth fundamentals of the company, we also looked at how closely the various weighting schemes are going to come to the way the average Lipper manager invests, the way the average Morningstar manager invests. And the idea was that the active managers may have some additional signals for value and growth that we don't capture with our universe of 11 factors.
I think it's a great comment. I want to turn the page from the growth and value discussion to bring in a few questions we've gotten from the audience on sort of cost savings. If people are wondering, Joel, if there's a way to quantify the cost savings that we expect through lower transaction costs and, lower trading costs, lower front running, are those significant? Are those something people will feel, or is that hard to say before we see them?
So it is hard to say before we see them, and the way that Vanguard actually reports expense ratios is actually a little bit different from the rest of the industry. Because of our at-cost corporate structure, we actually report our expense ratios in effect in arrears. That is what the historical expense ratio has been over a particular period, whereas a lot of times expense ratios in the mutual fund and ETF industry are set by the board as a forward-looking approach. With us, it's what did it actually cost to manage the fund over the most recent period. What you will see in terms of expense ratio differences most immediately, the one thing that you'll see is in total stock and in our small cap index, because CRSP does not include in their indexes business development companies, there's going to be a stated reduction in the expense ratio when that gets updated, that reflects what's called acquired fund fees and expenses, or AFI charges, which are 1 basis point currently in total stock and 6 basis points in small cap. But that's not a real charge that's paid to the underlying investors. It'll just show up as a difference in the stated expense ratio, but it's reflecting just the management costs of these BDCs that have to flow through in the expense ratio calculation. In terms of the other portions of the expense ratio, those are just going to be long-term cost savings. It's hard to quantify those today. It's going to depend on cash flow, market performance, and just sort of the general evolution of the portfolios. The other things like transaction costs are even harder in some ways to see, because they are baked into the performance of the portfolio that is reported through the net asset values or through the ETF mechanism, also in the market prices. So those will show up in performance over time, though it's obviously hard to sort of exactly quantify what those numbers would be, although if you see differences in transaction costs, it should show up, for example, Matt, on something like differences in the tracking difference. Because an index has no expense ratio, no transaction costs in it, you might see tighter tracking if we are successful in having lower transaction costs from the management of the index fund. But, that time will tell on that, and there's so many other things that go into that, it's going to be hard to actually tease it out directly.
Super. We've gotten a bunch of what I think very respectfully skeptical questions, and I want to sort of roll a couple of them together. Joel, in your sort of closing slides, you went through and sort of pointed out, I would sort of summarize a lot of your slides to say the differences aren't very dramatic between some of these, the previous index and the new index. In terms, there's some tweaks in market cap, there's some tweaks in sector exposure, which has caused a couple of our listeners to beg the question, kind of why bother? I mean, what is it that Vanguard is trying to do here if, in fact, the differences, in the transition period really aren't that dramatic? Could you just sort of maybe restate the value prop here for me as an investor?
Yeah, it definitely comes down to the long-term value proposition and, the sort of regular oversight of our funds by our board and by the portfolio management team in terms of managing the funds, which is that we looked at it as, yes, there's not a lot of difference, meaning that we are still achieving high-quality indexes that represent the market segment that is being targeted by a particular fund, but we're able to do it in terms of lower index licensing fees over time, and in some cases we believe lower transaction costs in the ongoing maintenance of the indexes through time. So the value proposition is same quality approach to index construction with lower execution costs for the end investor.
Right, and just to follow up on that, we've had a few questions sort of to the end of if I'm an advisor with a sophisticated client who hasn't heard about the CRSP indexes, what would you say to them about this transition? Simply that they're high-quality indexes. How would you frame that in your discussion with clients?
Well, I think it's, I guess the one way I'd frame it, and Matt, I almost go back to a slide that you and Dave like to show at times, which is that the major broad market U.S. equity indexes, they may have different names associated with them, but their long-term performance is extremely similar. So that what you're ultimately getting with different index providers is a market representation, and that remains the same, whether it be CRSP or S&P, Russell, MSCI, and so forth. We can talk about little nuances in methodology, but you're getting asset class exposure with what you're targeting, and to the extent that you can do that at a lower cost and therefore higher, we hope, all else equal, certainly all else equal, higher return for investors over time, to us that's a benefit for not just the advisor, but ultimately for the end client and the investor. And at the end of the day, we're going to be able to evaluate the CRSP indexes just like any of the other index providers. The holdings are available, historical data are available on websites, and will be presented through different data providers. And CRSP, for example, is on Bloomberg and so forth. So there, the information will be the same and can be evaluated and so forth. And we think the value proposition is the fact that you're able to keep more of the indexing costs for yourself as the investor through the approach that we've chosen.
Joel, you kind of teed up a question that we've had a surprising number of folks ask, and this is really for the CRSP and Chicago folks. Our audience tends to be on the slightly nerdier academic side already, and we've had a number of folks ask what the availability of either back-tested data, back-tested holdings for either the traditional sort of market cap style funds or the more growth and value style indexes. How can folks get at this data? What's going to be available without additional charge, or if I don't pay $20,000 a year for a Bloomberg terminal, how can folks get at this data to start playing with it, putting it into their own modeling, and seeing whether or not it's right for them?
Everybody's looking at me across the table. It always flows downhill. The backtest database was constructed at a particular point in time for us to prove out some of our concepts. It was not constructed in a manner that it is a marketable or distributable product, unfortunately, at this point in time.
So the short answer is, for now, it's pretty much whatever's going to be available on the website is what you're going to be able to get?
Correct.
Great, there you have it. And one last question for you, Joel.
If I may, returns are available, I believe, on the CRSP website.
Oh, yeah.
Correct?
Our returns, excuse me. I have had numerous requests from our academic cohorts about the underlying details of the modified version of the CRSP historical database, and that is not available. Our returns are available. They're on the website.
Super helpful. One quick question to you, Joel, from the audience, which is a good one. I think as we move into the transition, people have brought up the transition Vanguard made back in 2003 to the MSCI indices. Are there anything that's changed from them? Anything you learned from them, or anything that foreshadows for the transition we're going to see to these indices?
Well, I would just add that we learn from every transition of every benchmark every year. Like I said, in many ways, this is yes, it's a move from one provider to another provider, but there are execution costs and strategies and so forth that are done each and every year in existing index providers. So from our portfolio management standpoint, it's interesting because it's going from one portfolio and having a trade list to go to a new portfolio. And that's not necessarily old index to new index. It could also be existing index to existing index. So from our portfolio management standpoint, we're just thinking of it as a transition that normally would occur. This one may be a little bit bigger than a normal transition, although not tremendously so. And the learning really is, constant over time about, making sure that we, for our investors, balance the tracking error, market impact, transaction cost elements in transitioning these portfolios in the most effective way.
Well, great. I appreciate that. We have run over. There was a lot of interesting things to cover, but I want to thank everyone for attending the webinar today. I thought this was great. Obviously, a huge amount of interest in this. It's welcome to have CRSP on the scene with Vanguard, and we appreciate them coming out and speaking to everyone today. I'd like to thank my co-host, Dave Nodegg, as well as our panelists, David, Joel, John, and Lubos. I think this was a fantastic webinar. As Dave mentioned, copies of the slides will be sent to you, or an alert will be sent to you by email pointing you to where you can get copies of the slides and recording of this webinar. You should receive that email within a few days. I'd like to thank everyone again for attending and have a great rest of your week.